Good morning, everyone, and welcome. I'm Maureen Lowe, Founder, President, and Editor-in-Chief of Financial Technologies Forum and our online news service, FTF News. I'm serving as the moderator of today's event, Artificial Intelligence for Asset Managers. Ignore the hype, focus on the value. Produced by FTF and sponsored by Publicis.Sapient. The use of artificial intelligence as the next innovative technology in financial services has been a hot subject in our industry, and given the number of people we have registered for today's webinar, it seems to be on the forefront of many of your minds. Artificial intelligence could be a possible key to unlocking business value in the near future, yet there are financial services firms that still see it as a superficial solution. They might not fully understand how to incorporate this very disruptive technology into their business practices in the most effective way. During this webinar, we hope to debunk some of the myths around artificial intelligence, shed light on opportunities available today, and the opportunities that are not that far away. We also want to answer your most pressing questions, such as, what exactly is artificial intelligence? How is AI most valuable to and commonly used by asset managers? What are the drivers behind the perception of AI? How can firms use those drivers to get buy-in across the enterprise? And finally, what are some of the prerequisites for asset managers to truly leverage robotic process automation and AI in ways that demonstrate measurable results? Before we get started on today's discussion, however, I just want to go over a few administrative details, starting with Cpe Credit. Eligible participants can receive 1 Cpe credit for listening to today's webinar. In order to receive the credit, you must stay on for the entire duration of the presentation and participate in all polling questions that we ask during the 60-minute period, starting with the one on your screen now. So if you haven't done so already, please do take a moment to indicate if you would like to be considered for Cpe credit. And we do also ask that you only request them if you're required to do so by the NASBA. So if you're wondering who they are, that probably don't need them. And Cpe credits are also available to those listening on the live event and not the recorded version. And while we're waiting for people to answer, I just want to go over briefly your event console. You'll see there's a Q&A window open to the left of your slides where you can submit questions at any time. We do advise that you take the opportunity today to ask questions of our experts, and we will be addressing those questions along with some of the ones that you've submitted during the registration process during the last 10 minutes or so of the webinar. And just so everybody knows, questions are confidential to presenters only and not seen by other attendees. If you are listening to the on-demand version of the webinar, you can still submit questions that will be emailed to us and answered accordingly. And in the resources window, you'll see we've provided some additional content for you to download, including a PDF of today's presentation, along with a couple of white papers that you might find useful called Can Banks Get Smarter? Rethinking AI in Financial Services, and another one on cognitive wealth management. So with that, I'm pleased to hand over today's discussion to our presenters who will introduce themselves.
Hello, this is Rashed. I'm the global lead of AI, robotics, and big data at Publicis.Sapient. We're a global consultancy that was purpose-built for today's digital transformation imperative, and most of our clients are in the capital market space.
Hi, I'm David Poole. I'm really happy to be here, and I work with Rashed in our financial services practice.
And this is Celi. I'm the CEO of ESI ThoughtLab, a company that focuses on analytically driven thought leadership. And today, I will be telling you about a study we did together with Sapient on wealth and asset management.
So we're looking beyond the hype around artificial intelligence, of which there is an abundance. We want to focus on what value AI can offer asset managers today and in the near term. So we'll cover why asset managers are using AI, then what AI can offer, and lastly, how to win with AI. But first, we'll start with defining the term. This is what AI really looks like today. There's no shared definition of artificial intelligence. You've probably heard author David Foster Wallace's story, which suggests why that is. So there are these 2 young fish swimming along, and they happen to meet an older fish swimming the other way, who nods at them and says, "Morning, boys, how's the water?" And the 2 young fish swim on for a bit, And then eventually, one of them looks over at the other and goes, what the heck is water? AI is like that. AI is so ubiquitous, we're not even aware that we're engaging an algorithm each of the 76 times a day we access our smartphone, or in a constant stream with connected devices monitoring our natural language like Amazon Echo. We experience the impact of the reduction in spam in our webmail, the accuracy of online searches, faster routes in maps, individualized entertainment and shopping recommendations, and personalized content in our social media feed.
And AI exists on a spectrum, increasing in intelligence and complexity, as you can see on this graph, from basic robotic automation to machine learning, deep learning, and then causal reasoning. And there's more enterprise adoption today in the simpler types of AI towards the bottom left, even though there's more potential ROI in the more complex types that are on the top right. And the time horizon for those is probably a little bit further out.
So with that definition in mind, why are asset managers using AI? Well, it's the same reason that they're digitally transforming their business. You've seen all of these drivers, the power shift from money managers to money holders, their rapidly changing expectations, the growth in non-traditional client segments, such as the $30 trillion wealth transfer to millennials, acceleration in digital adoption, years of sluggish returns, and the increase in outflow from active to passive funds. And we see that in the inflow to Vanguard passive funds last year, $328 billion in 2017. And of course, fintechs, those refreshingly simple, low-cost digital-first experiences, and the ongoing tightening of regulations. The cost of adhering to these complex and ever-changing regulations is quite a cost burden, with an estimated 300 million pages of financial regulations by 2020. And that's why there's an imperative for digital transformation and enabling technologies like AI for the 3 Cs: cost reduction, compliance, and competition for customers. In Sapient's survey, when we asked asset managers to rank drivers for transformation, self-disrupting to compete for assets led well ahead of cost reduction. Lou, I think you conducted a survey with ESI, so what did you see?
Well, we saw a few things on digital transformation. One is that asset managers are giving a high priority to becoming a data-driven organization over the next 5 years. They understand that data is the fuel for digital transformation, and they understand the models that work for Silicon Valley need to be brought over to the industry. They also, we found that 54% plan to increase their usage of data and predictive analytics over the next 5 years. So there's a move to harness data across the institution. And AI, of course, is a very powerful way to make that all happen.
But AI adoption is still relatively low. So if we look at this data, which is broadly for financial institutions, we see the traction in biometrics, fraud, and robo-advisors. We're going to move to our first poll to hear how you're seeing traction in your organization for this technology.
Great, thanks, David. Yes, that brings us to poll question number 2 for today. If you can choose one answer of the following, which of the following statements best describes your organization's current approach to artificial intelligence across all business units? Please select one. We are already a fully cognitive enterprise and continue to invest to strengthen this position. We have implemented a significant number of AI initiatives in the past 5 years and are now combining these initiatives. We have implemented a significant number of AI initiatives in the past 5 years, but these initiatives remain siloed. We have defined a significant number of AI initiatives across the enterprise that we plan to implement in the next 5 years. We have implemented or plan to implement a limited number of AI initiatives. And finally, we have not implemented nor do we plan any AI initiatives. I just want to invite everybody to participate in today's poll and just remind those that need CPE credits that we do need you to participate. We will be sharing the results with everybody. I know these are a little bit long answers, so we're going to give people a couple more seconds to respond. I know there are a lot of you out there. It's just a fun way to interact with today's call. And if you are listening and you have a colleague that you feel would benefit, we will be having this event on demand on the FTF site, so they can still register and listen to the recorded version at a later date. Just give everybody a couple more seconds. It looks like so far the fifth option is the most popular, but let's see how it ends. Okay. Yes, it seems that 52.9% of our attendees have indicated that we have implemented or plan to implement a limited number of AI initiatives. Do you guys have any opinion on that?
So I think, Maureen, that shows there's still a lot of upside and that it's still relatively early days if you think about a sort of maturity curve for AI within asset management.
Yeah, and I would add to that, it ties into the results of our survey of 1,500 organizations and 100 wealth asset management firms. We found that it's early days for AI, but folks plan to be increasing their use over the next 5 years in a pretty dramatic way.
Mm. Yeah, I'd speculate that if we change the question to not be across all business units, we'd see a significant uptick, that within certain lines of business, you may see more experimentation with this technology.
Yeah, but I think experimentation is the word. They're starting to develop use cases. They're not rolling it out in a meaningful way across a lot of functions. And so that's really different. And another difference, when we look at wealth asset management firms versus other areas of wealth management, say universal banks and the large insurance companies and so forth, the asset managers tend to be a bit behind the curve, and wealth advisors very much behind. On the use of AI.
You know what's interesting on this and these results is from bottom to top you can see a nice Gaussian curve, and if you look at retail 5 years ago to maybe a year ago, 5 years ago it looked similar. A year ago that bump had moved further towards the top.
That's exactly right, and retail is the area to watch. When we did our study, most organizations are not comparing themselves with other wealth and asset management companies. They're actually comparing themselves with Silicon Valley. Silicon Valley is setting the pace and direction for the wealth and asset management industry. And folks like Jamie Dimon actually said so in his annual report.
Okay. So we've established why asset managers are using AI as part of their digital business transformation to disrupt and compete. So now what can AI offer across the value chain? So Lou, ESI asked asset managers to rank the top 10 benefits of AI, from tracking sentiment to automated advisors. What did you learn?
Well, first of all, if you look at this slide, you can see that it actually mirrors what we just saw in our own Pulse survey. So it's still early days. One thing you could see, the top 3 areas that the top 3 use cases for AI are the following: track sentiment and market trends, enhance portfolio management, increase productivity. There's some other objectives: to forecast trends, use it to understand investment behaviors, to attract and find investors, tying it into cybersecurity risk, which is very important because AI can help you understand and predict cybersecurity risk, compliance, back office, and so forth. So one thing about AI, as you can see just from this slide, it's very versatile. It can be used to do multiple things better. But it's still early days. If you look at everyone who's using AI, I think the number overall is around 21% that are actually using AI now in some way, shape, or form. If you look at this slide over the next 5 years, it will grow. It will, in many cases, double, but still off a small base. And so although many companies see the value of AI, they are not moving as fast as other industries, and not even as fast as digital leaders in their own industry, which you can see on the right-hand side. So whereas 9% of companies are using AI to track sentiment and market trends now, 29% of digital leaders are already doing that. Whereas 8% of asset management firms are using AI to enhance portfolio management, almost half of digital leaders are doing it. So this shows the gap, and that gap is only going to get wider if companies don't move quicker.
And as you can see on the left side, there's value to be gained from AI across the board in investment, distribution, and operations. And I'll go through a few examples from this list. So from the investment category, I'll talk a little bit about news signals and behavioral signals. And from the distribution category, I'll talk a little bit about engaging investors more deeply. So, many firms are already engaged, as you saw, with AI for investment research. The example on the earlier slide was about sentiment tracking. And with the use of these emerging technologies and even more importantly, the data, investment research workflows changing significantly. So on the data collection side, people are using alternate data such as social, news, satellite imagery, and so forth. Those are getting merged into traditional data sets. And for analysis, machine learning is being used more and more now. And then lastly, for pinpointing relevant information, semantic natural language processing is being used as well. So if you look at the investment research area, research analysts have a daunting task ahead of them, right? They have to act as an industry expert, a technical expert, often as an auditor of financial reports. They have to be a good judge of management talent and so on. Right? So those are all the hats they have to wear. And at the same time, they're looking at immense volumes of data. So everything from traditional data that they were looking at, such as SEC filings, financial reports, and so forth, to some of the newer data types like satellite images, geolocation, foot traffic, etc. And these are very time-consuming tasks that can be automated using AI. So for news signals, for example, we can parse all the news sources that are shown in this diagram on the left side and use machine learning and natural language processing to predict things like, is the company's revenue going to grow? Is it in a strong enough position relative to its competitors? So placed well for the future? Is it going to be able to pay off its debt and so on? And for behavioral signals, so these are the examples on the right side, we can collect things like geolocation data on foot traffic or online consumption data to be able to find trends in supply and demand, and then use machine learning to predict future supply and demand based off of that data. And some of this data has been used for some time, like the example about the SEC filings, but a lot of this data is also new because of our increasing digital footprint. More and more data is becoming available. And the use of machine learning and natural language processing is certainly new and emerging that we just saw in the earlier surveys. And these together, both the data and these AI techniques, is enabling an order of magnitude improvement in productivity, both in terms of efficiency, but also in terms of the quality of the information and recommendations coming from the research.
So Rashed, it's not just that notion of completely new data sets. It's the feasibility of taking data that research analysts have had and just making it practical to leverage that.
Yeah, absolutely. And there was one research analyst I was talking to, and he was saying that in the past he could look at 4 or 5 companies per week. Now he can look at over 40 per week because a lot of the information gathering has become easier using natural language processing. So he can get very specific pinpointed information and doesn't have to dig around, right? So, and that brings me to this, the last part of the research analyst's workflow, and which is the semantic knowledge retrieval. Now, the way to think about this is that if every research analyst had an imaginary friend who could accurately answer any question that they're asked, how would that improve the productivity of the research analyst? Right, and that's the idea here of information retrieval. And what you see here on the screen is a 3x3 matrix. It's showing 2 dimensions. The horizontal axis is about understanding what the analyst is asking for. Right? So this is from the AI's perspective, can it interpret the question that the analyst is asking, and then it has low to high complexity of the question itself. And then on the vertical axis is the other aspect, which is once you understand the question, can you figure out what the answer is, or can you find the answer? So there in the vertical axis, the lowest level of complexity may be just looking up structured information. The mid-level complexity is looking up unstructured text information, so being able to semantically understand what was written in a document, make sure that that matches the question being asked, and then come back with the answer. And then where it gets really interesting is this top layer, which is about deriving answers from data, but the answer is not quote-unquote written down anywhere. Right? So for example, if there's a question about the impact of interest rates on the tech sector in some future time, then it may look for all the historical data and then create a prediction using machine learning to come back with a response about the future. And so these kinds of tools are significantly improving the research analyst productivity. Now, let me switch gears and talk a little bit. Sorry, was there a question or comment?
Well, I was just going to say, I think what's so exciting about that is the unexpected patterns and opportunities at that highest level that could be revealed. Yeah,
and one of the things, like on that top level, there's the correlation aspect, like the one I just described, predicting from historical data. There's also causal reasoning, which we mentioned earlier as the most complex type of AI in commercial use. And that's sort of qualitatively different, right? So one example to try and understand causal reasoning is if you ask on Google, do a Google search for what was the height of the president when Obama was born, there's a very high likelihood that it'll come back with Obama's height. But because it's all correlation based in terms of the search ranking, that's machine learning. But if you ask a causal reasoning engine, then it will say Obama was born in 1961. In 1961, the U.S. president was Kennedy, and Kennedy's height was 6 feet 2, and hence the answer is 6 feet 2 and not 6 feet, which is Obama's height, I think. So that path of reasoning becomes very interesting and can lead to interesting new insights.
Yeah, and I would say, Rashed, just to add to that, the asset management firms that we're talking to see data and AI as very important for enhancing their portfolio management. And it's coming from everything that you're talking about. So in the one area, it's coming because AI can give them access to a wider range of data much more quickly. And as we all know, the person with the best data and latest data and that can act on it faster wins. And so that's one thing, arbitraging, data. But the other point that you're making, which I think is very valuable, is it improves decision-making and future trends and predictions. And it's particularly helpful in working on scenario analysis. And what a lot of asset management firms like to do is not just have a model that shows an economic prediction and the impact it will have on financial instruments, but they're also doing scenario analysis and impact analysis, and that's a really important future trend. Understanding how a tax change will affect the financial markets, understanding the impact of a political shift in Europe on bonds. And so those are very hard to predict with certainty, but what AI allows you to do is actually understand those emerging trends, come up with those scenarios, and see the impacts. And that's a really important task for portfolio managers.
Yep. So let me switch gears and talk a little bit about distribution. So here the examples are about improving investor engagement. And this first example is about finding a moment that's important for some set of investors. So, for example, noticing that a set of investors are trading the volatility index whenever it's high. So when we notice that, we can then ask who is trading this and find those people. And then we can ask, and this is where machine learning becomes very important, then we can ask, what are other look-alike and act-alike investors who are not trading this index? So now the next time this index is high and we see that first set of people trading, we can immediately send a message to the others saying that here's an opportunity that they can take advantage of. And then because they have similar interests to the people who are trading, they can also start doing these transactions. And in this example, which we did for a company last year, the increased transactions led to a 5% increase in revenue in terms of fees. And what's really interesting about this is that we didn't have to sit down and come up with ideas of what behaviors or what moments to look for to target. We just looked at the existing data set, found the behavior. This was the behavior being trading the volatility index when it's high. And then we looked for other people who might be interested through machine learning. In this next example, we're creating user segmentation using machine learning. So on the left side, this is a company where I'm getting an echo. So this company was using user profiles to do segmentation based on rules, like hard business rules, and they were not getting a lot of different segments, so their targeting wouldn't be very precise. And on the right side, you can see what we did is we brought in not just the profile, but some of the parameters from their transactional information and then user behavior from their mobile and web usage. And we created segments using machine learning and clustering. And this led to much more precise segmentation, and now we can much better micro-target. And then on the next slide, you'll see for the targeting to work, you also need to segment the content. Right? So by content, I mean both types of things, which is content like articles, but content can also be offers or products that we want to cross-sell or upsell. And once you've segmented the content, then you can match the user segments to the content segments. And on the left side here, this company was using, again, rules to do the matching. And on the right side, we're using machine learning again. And this new approach to do this matching improved the acceptance rate of the offers or recommendations from 33% to 76%. Right? That's over 100% increase in the offers being accepted. And what's good in these examples is that it's not only valuable for the company implementing these in terms of the incremental revenue, but it's also a better customer experience and more engaging investor experience, because these are experiences that are much more personalized to the investor.
Yeah, what's remarkable, so you can see it in the chart on the left, is how many customers will receive a generic offer. And even when personalization is in place, if it's rules-based, more often than not, the customer is getting an offer they're going to get saturated with, and the effectiveness of that is going to decrease over time. So there's a real advantage to the use of AI.
And that's where it ties into the retail industry, because the retail industry, as Amazon would say, or Bezos would say, he's customer obsessed. And to become customer obsessed, you have to really understand everything about that customer and have that data at your fingertips. And I think that's what AI allows you to do. You get a 360 view of the customer, so that you can not just micro-target, but you can sell, upsell, attract new ones. And that's crucial for the future of businesses in the industry. Understanding your customer in wealth and asset management is just as crucial as it is in retail and consumer markets. And so you need to use very much the similar tools.
So with that in mind, on to our next poll.
Great, thanks, David. Yes, that brings us to our third polling question today. This one's a little bit different. It's going to pop up on your screen so that you can refer to the chart behind. You are also able to move the pop-up window so you can refer to the screen, the slide, the chart behind there. So in this question, we want you to be able to choose as many responses as possible. You don't have to choose one. Select all that apply. Which of the following AI use cases is your company applying today? And we've broken this down into the different business units. So investment area, new signals, behavior signals, knowledge as a service, portfolio management, autonomous trading. In the distribution arm, targeted customer acquisition, customer retention, deepened customer relations, institutional behavioral insights, smart client servicing. And finally, in the operations unit, surveillance, compliance, intelligent post-trade automation, AI-enabled IT support, and AI-driven data quality. I know we have a lot of options there for you to select, so we'll give you a little extra time to participate in this polling question. We will be sharing the results with you again like we did the last time. We have some questions about the presentation. We just want to remind everyone that you can download a PDF of the presentation on today's event console, as well as some other materials that we've left for you. We're getting some submissions. There are a lot of you out there. We do ask that you interact with our console today. Again, we want you to be able to select all that might apply to your business. Just a couple more seconds. And we will push the results momentarily. Okay, here are the results. It looks like the top is AI in operations, AI-driven data quality.
Yeah, I'm not surprised about data quality because that's a major pain point for any of these kinds of initiatives, is having clean data, having data organized and structured so you can actually use it effectively. So that's really foundational. New signals is also performing relatively well, and that seems to be low-hanging fruit, making use of some publicly available data.
Yeah, I guess when you look at this, what the data is telling you is that it's about data quality and getting the data, getting more data, higher quality data, and getting it faster through the new signals. I think another key area is the portfolio management, which comes out pretty strong here, and obviously having the data helps improve that. What comes out a little bit, some of the back office stuff and trading and post-trade automation comes out here to some degree. And client seems a little bit low, customer, which could show a vulnerability, since a lot of this is about getting better information to your customers so that you can drive your business forward. So it might be an area that folks on the phone will want to think about harder.
Rashed, anything to add?
I think I agree with Lou in terms of the places to watch out for. I am a little bit surprised at in terms of operations, that like compliance surveillance is lower than I was expecting. That from many of the discussions we've had tend to be an area of high interest. I think the others definitely make sense.
Right.
And I think in general it shows that it's early days, David, right? With all of these, people are still finding their way.
True. So with that in mind, we've talked about what AI can offer. Let's look at how to win with AI. Lou, you've been talking to leaders in the category about AI that's here and now. So what have you learned?
Well, first of all, I've learned what the survey statistics just showed us, that folks are using it for different purposes, and they still have more sporadic use of it. They're not using it across the whole institution. They're using it for certain activities that are important to them. So take Putnam, for example. Putnam is an active management firm. It's been around since 1937. It manages now about $137 billion. We talked to CEO Bob Reynolds. He makes the business case for active management, as he would. He says active management is about the arbitrage of information, which AI allows him to do more efficiently, less expensively, and certainly more quickly. He also believes that AI and the related sort of advanced analytics allows them to look at data across the board, as Rashed was saying earlier on, data on behavioral data, market data, psychographic data, all the macro data, all the trends that might be important for a portfolio manager to look at. And what Putnam is doing is actually bringing this data and analysis together every day through artificial intelligence and advanced analytics, and then putting it right on the desk of the portfolio manager with their coffee when they come into the office. So that's a really good example. Now, Credit Suisse is doing something a bit different than that. They're using AI to do more on client behaviors. Credit Suisse believes that it's very important to get a full picture of the client. What they said was the client in Technicolor. That helps you service them and better and find them. And so that's really important to Credit Suisse. So they're using AI to do what I don't think enough people in the survey said they were doing, which is to understand client behaviors, to better target services to meet their needs, to understand the correlation between customer behaviors and financial needs or psychographic and targets for Credit Suisse. So they're thinking beyond just the normal targets of age and wealth levels. They're thinking about all the other kinds of characteristics that might give them insights into their customers, their expectations, and their needs. They're using AI to do that. And they're also using their new digital wealth management products and robo products to gather more data, just like Amazon gathers more data when you buy services through them. And that's going to allow them to actually make better customer and product decisions in the future. Mm-hmm. So now Blackstone is in the camp of Putnam. We talked to Bill Murphy. He's the CTO of Blackstone. And, he basically thinks that data will make them better product portfolio managers. Now, he knows it's early days. They're still experimenting, but the idea is that he sees his company becoming more of a bionic organization where humans and machines are working together to really come up with the best portfolio management decisions. And so it's similar to Putnam, but it's actually, he's thinking about including AI more into the actual models that they use to do their portfolio management. Now,
hey Lou, what you're saying about Blackstone and Putnam, are you finding actively managed funds are getting more attention, or is it more of the passive fund managers?
Well, this is the part, David, I think is interesting. A lot of people just think, technology, that's going to be about passive. That's going to allow passive to work faster and easier and cheaper. And that's true, but technology can also help active management. And that's what some people forget. And it helps because of the reasons that we're bringing out today. So if you have the ability to arbitrage data faster or get access to more data so you make better decisions, or you can use artificial intelligence together with your momentum models and economic models to come up with a better investment decision or to reduce the risk of a portfolio, that puts you a step ahead. And so when you are an active manager or even a personal wealth manager, you're thinking, what is your niche? How are you going to compete against a digitally enabled robo-advisor? And that is by micro-targeting and by making much better decisions and doing what active is supposed to do, which actually is supposed to give you higher alpha and beta than passive. Make sense?
Yeah, it makes a lot of good sense.
So that's what we're finding.
How about other examples?
Yeah, so Schwab, for example, we put them in the category of smart client servicing. So you all know Schwab was one of the first, digitally enabled asset management firms. They actually have 10 million accounts at this point and only 1,200 financial consultants. So it's impossible for 1,200 people to manage so many accounts. That's where AI helps, and they're using natural language processing in a way to understand human speech and to be able to provide more personalized insights and increase the productivity of those 1,200 consultants. So that's important. We also talked to BBVA, which is one of the top digital companies. I don't see them on this list, but BBVA is using natural language processing specifically to engage with their customers, and they're using those messaging systems to go right, to the contact center, and they are currently rolling out a capability to actually handle messages and get people to the right place without using humans. And so that's how they're using it. So it's similar to what Schwab is doing. And then you have a firm like eToro, which is a fintech, and so fintechs obviously are all over AI, and this one is using artificial intelligence to actually support its business model. Its business model is eToro is a leading social trading and investment platform, and it creates copy funds using AI. So the technology copies the portfolio management strategies of top traders that AI actually can select and identify. And then it allows users to come onto their platform and basically, copy that style for their own portfolio.
So I think, Lou, the key takeaway here is that for these digital leaders, AI, it's here and now. So I think the question is how to win, and our recommendation is just get started. But how does that contrast with the traditional way that one of these initiatives might be rolled out?
So I think, to win, there's a few paradigms that we have to break out of, and then others that we need to shift into. And, we have to remember that when we're building AI models, humans are not coding the logic, but machines are creating the logic based on the data that they're given. So there are two implications that come out of this. Sometimes you won't know whether the model is going to work out or not when you get started. Right? This has to come out of the experimentation, and then you determine the use case around it. So a few things to keep in mind. One is that data, so in this case, data is the input and not the output. So traditionally, you build the application and data is the output from that, right? And this means you have to have a way to manage your data even before you start building any models, right? And you always want to be on the lookout for collecting new data, buying new data, or instrumenting other parts of your business to collect more data. So all those things need to come up front. And then the other thing is you're building a platform and not an application. And a platform for building models, for being able to do rapid experimentation and quick deployment. And so on top of the platform, you may be building hundreds or thousands of models or applications. Right? And so the companies that have made this change from an application mindset to a platform mindset that's being driven by data are seeing much better ROI, because once you've built the platform, you can run those experiments and run those model building in a much shorter time frame. So it's basically in the order of weeks instead of the order of months. And for companies that are not building the platform first, each time that they try to do a model or a use case, they're provisioning the data, they're provisioning the high performance compute environments and so on, and that takes a lot of time and engineering cost and so forth. Yeah, in this final slide, I wanted to share just a survey in capital markets and what types of AI are being used by them. So this is a little bit broader than just asset management. And here you can see natural language processing is being used the most, followed by RPA. And that goes back to the things around news signals and so forth that we saw in the poll earlier. And the machine learning is being used the least, Now, in this survey, I don't agree with 0% being deployed as the graph shows, because I know companies that have deployed machine learning models into production. But I think the trend I agree with, which is that it's the least used. And I think this highlights one of the things we haven't talked about, which is the black box nature of machine learning, and that is a concern for people trying to deploy models into a production environment. And the black box problem is that with machine learning models, when it makes a decision or recommendation, you cannot see an explanation for why it made that recommendation. Most of the time. There's a few models where you can, but most of them you can't. And that makes it challenging for people to get comfortable with if the model is making the right types of recommendations. But there are a few things that companies can do to mitigate this. So for example, doing sensitivity testing with all the input variations once the model is built, so that you know what kinds of outputs you'll get, or building more localized surrogate models that are more interpretable, right? So that you can get localized answers of why the recommendation was made. And all of this needs to happen under a robust governance model process, which is often something like a model risk office. So let me end on that note.
Thanks, Rashed. So to recap, focus on the types of delivery that are offering value today. So those are the less complex AI technologies, RPA and machine learning. AI is why asset managers are using it. AI is a key enabling technology in your digital transformation to self-disrupt and compete more effectively. We see that AI opportunities exist across the value chain, so prioritize the use cases with the greatest near-term value. And then winning with AI, it's about just getting started and approaching with a platform-first data-in mindset, think holistically across the value chain, and assign owners by customer journey. So with this formula, we believe asset managers can ignore the hype to focus on the value that AI offers today.
Great, thanks everyone. We want to move into the question portion of the webinar with the time that we have left. So if you have not done so already, please submit your questions. And if we don't have enough time to get to everybody's question before the end of the hour, they will be addressed by your presenter following the close of today's webinar. So with that, let's just get into it. So the first question we have here is, how much visibility, transparency, and control should you give users about how the AI operates?
So I think that in this case, for the company itself, you definitely want as much transparency and control as possible, which is something I was referring to in that governance comment at the end. But how much of that you give to users would be similar to how much you'd give in terms of, even if you didn't have AI. So whatever the employees were doing, you wouldn't give 100% transparency. In the same way, you have to decide how much you really want to give in these situations. AI shouldn't make a big difference in this case.
Okay. In asset management firms, which teams have typically led AI initiatives? Digital, strategy, analytics, IT, or are there others?
Yeah, that's an interesting question, and I think that from what we've seen, it's all of the above. It depends on who gets started first. But the most, if there is a digital strategy team, they generally start. If not, it's some combination of the business and IT leading it. And analytics teams, historically, they've been more focused on financial engineering or quant type roles, and they haven't led as much, but in some cases, they've also done that.
I also see a matrix between the function and the IT department, Rashed. So, for example, we talked with folks that are responsible for the digital experience or customer experience, and they're working together with the IT team to come up with AI solutions for those activities.
Yeah.
Okay, and follow up to that, what's the best way to start integrating AI into current business practices? From those who have successfully implemented AI initiatives, has this been done using a dedicated AI team or integrating AI objectives into each key team or division?
Yeah, this is a really good question, and I think it goes a little bit back to what Lou was saying. So what we find, one of the hardest hurdles to get through is getting talent. And usually the best way to get talent is to have a centralized AI team. They don't have to be the ones implementing everything, but there has to be a center of excellence that drives that. But the best model we feel is that you can start in that kind of centralized way, but move to a federated model as soon as possible, which is having AI people in each of the business units with a combination of business and IT and machine learning people. And the reason is that if everything remains centralized, it sort of operates like an ivory tower. But if everything is decentralized and everything is in the business unit, I was talking to a CTO recently at an asset management firm, and he said that he realized that they were doing the exact same project in 6 different business units without realizing it, right? So that leads to a lot of wastage and not being able to leverage lessons learned from each other. So doing something in between, which has a centralized team or a center of excellence and a federated model, so each business unit has their own teams to do specific projects, that usually works. And
I would agree with that. Go ahead.
The other thing is the centralized team also then can drive the platform features, and then the federated teams can drive the applications that are getting built on the platform. Louis, you wanted to add some more?
Well, I was just going to echo what you said. I agree with that, and I think what we're finding is that the most advanced firms, the firms that are digital leaders, have developed a culture and organization that embraces innovation right down to each of the functional areas. And so, you don't want it to be just top down. You want it to be bottom up innovation. That's very important. The other thing I would say too, which, is part of this question, we're finding a lot of companies are deciding not to just do it all on their own. So they're building ecosystems of partners and vendors to help with all different aspects of it. Because if there's already an off-the-shelf solution that could allow them to build it, very fast, as opposed to waiting 2 years, then that's favored. So in this area of constant innovation, you have to have, I think the center team of excellence that Rashed is talking about. You also have to have the bottom-up support of your people right in each of the. And you need to have a really strong ecosystem that you can bring in the right solutions quickly.
Okay, great. Thanks, everyone. I think that brings us to the conclusion of today's call. Again, if you've submitted a question we haven't been able to get to, we'll try to have one of our presenters respond to you. And we would like to thank everybody for attending today and to all the speakers for doing a great job. Thanks, everyone.
Thank you.
Thank you.